Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Is this stock market Icarus's greater fool's theory? And/or is Icarus, aka NVIDIA, simply flying too close to the sun? Everyone who remembers their Greek mythology will love this analogy. It's too bad that Alex the Greek, who's our option specialist, isn't here today. He'd love this, but we're going to talk about that and why it's the perfect analogy for this stock market, and then the 60-40 stock to bond positive correlation dilemma. My first question is, why is that a dilemma? Okay. And so let's talk about that. So the Icarus Greater Fool's Theory is actually kind of two articles that were are very related and cobbled together. And someone, a listener, and actually a client sent me one of those articles, and it's a perfect article. But first, before we get into that, I want to talk about the third article. And by the way, all these articles are in the show notes, so you can go check these out. And this article is saying where to go with positive stock and bond correlations. So remember, the kind of the theory is the 60-40 stock to bonds. The 40% is a ballast, and it kind of smooths out the stocks. And when stocks go up, bonds go down. And when stocks go up, bonds go down. And they're kind of an offset. Problem is, that's wrong. Okay, so I'm going to quickly hit the highlights. I've highlighted a few of this article quick. The strongest positive correlations in almost 30 years. The natural diversification and risk protection a traditional 60-40 portfolio offers is open to question. Sustained positive correlation. Some periods show sustained positive correlations. Other times it's negative. Actually, more often than not, stocks are positively correlated with a decent economy and what interest rates or inflation are doing. Anyway, the relationship.
Dan, why are you whispering about that?
I don't know. That's a good question.
Is that a secret?
I do. I'm leading up to it. I'm building suspense. The relationship between stocks and bonds is a primary factor for assessing risk in investors' portfolio. He's making a statement. My question is why? Why is that a primary factor, the most important factor? I would think if they're both positively correlated and they're both moving up, you probably want some of each, or maybe some of the one that's moving up the strongest, the most relative strength, as long as you have a sell discipline. Again, but then it says the function, investors can rely on the bond portion of their portfolio as a function of a counterweight to equities. In other words, a drag. It'll put a drag on the equities. Anyway, it says much of the last 20 years has been negative correlation, but now it's more positively correlation. Folks, in 1980, when interest rates started to drop significantly and we had a super cycle in lowering rates, stocks and bonds both went up for a couple decades. By the way, in the 70s, stocks and bonds both went down when we had high inflation and rising interest rates. So a lot of times, stocks and bonds are not positively correlated. So he said, planning for different investment backdrops, depending on the composition of the assets within a stock and bond portfolio, the traditional 60-40 allocation may not provide the risk profile or returns investors expect, meaning you should set it and forget it for a year and then revisit it every year. While portfolio construction in a period of positive stock bond correlation might be new to certain generations, meaning they're positive correlated, 70s, 80s, and 90s, they all experienced a similar trend. It's because they were correlated. Now, bottom line is what this guy is saying is because stocks and bonds are positively correlated, they're not offsetting each other. So it's time to revisit the recorrelation toolkit, and his suggestion, some private placements and some non-public stuff like direct lending in the private market, real estate debt, mostly in illiquid private market, And one last one, hang on, I'm trying to get this over. And macro hedge fund strategies. Here's a problem with macro hedge funds. They're highly correlated to stocks and bonds, so that doesn't make sense to me. But the conclusion, appropriate investment selection depends on the investor's goals, risk tolerance, and liquidity needs, among other factors. That's the first assumption we feel is wrong. It's more about the market risk and the market time horizon and the liquidity in the markets. That is paramount. You need to dovetail your risk tolerance and your time frame with the market. The market trumps your stuff. It just is. In any event, this article is really kind of trying to get you to move into other things that they're trying to fund, like real estate, commercial real estate papers drying up. New mortgages applications have dropped precipitously. They need some money to shore up some of the areas that are starting to lose liquidity. So I wonder if this article represents the sell side or the buy side. See, it's your money. That's why we named the show Your Money. It's your money and they want it. They think it's their money and they want to put it in where you think it should go. Let me ask Don what he thinks about some of these private lending funds and these private real estate funds. Oh, you know, Don, the ones that we've been having trouble getting out of, we had to try to sell it, and you can only put a sell 1 day per quarter. You got to put a sell in that you want to sell it, and they'll come back and they'll let you know how much you can sell, how much of your own money, your money, you can get back. Sometimes it'll be 20% or 30% if they have, and if they got too many redemption requests, you may not be able to redeem any of it. It's like the Hotel California. You can check in, but you can never leave. That's the problem. What do they call those funds, Don? Not series funds. I always get the name. I always forget the name. Do you remember the name of them?
Yeah, I don't. Periodic or something like that.
Yeah. Anyway,
terrible.
Serial.
If you must be one hell of a salesman if you can push something like that onto somebody. I don't know what excuses they're using or what reasons they are. I mean, I've never personally experienced it because I would laugh at them immediately.
I don't think they're disclosed very well. I think it's because of the 4 or 5 clients that came out. And by the way, that's kind of the hot area now. And so we've had 3 or 4 new clients transfer in with them. We had a lot more clients transfer in, but of the clients that transferred in the last month or two, we've had 4 or 5 that all had these funds. And about half of those did not realize they couldn't just sell it outright and just get their money. They didn't realize it might take a year, 4 quarters worth, and selling a fourth, whatever, to actually exit them. So if that sector starts crashing, you're at the mercy. And by the way, when those sectors do have trouble, that's when they do become illiquid and you can't get out. You're stuck in them. That's why it's important. Anyway, that article is called, where is it? It's in the show notes. You can see it. It's talking about the 60-40 positive correlation dilemma. But now I want to go
interval funds is what they're called.
Interval funds. I keep calling them
integral.
Is it integral?
They only sell interval because they only are available to be sold in certain intervals during the year.
And when they say intervals, certain intervals, they mean really 1 day a quarter. It's not really an interval, a range. You got 1 day. So you got about
and like you said, you can't necessarily sell it. They cap how much. It depends on how many people want to get out.
Right.
Ridiculous.
Right. So when it does hit the fan and everybody's rushing for the exits, you won't be able to get out. I don't want to sell. I don't want to buy. We don't put our clients in anything that's illiquid that locks them up. No commissions, no back end loads, no trailers, none of that. Okay. If I can't buy it 1 day and sell it the next day, or even 3 minutes later after I just bought it and changed my mind, I'm not interested in it. So anyway, that's one thing that you've got to be careful of. Now, the other 2 articles, and these are very, very good, and they're related to each other. So I want to kind of tie these in because I got a listener in the mailbag, and I'm going to read that real quick. sending me this article, and basically the title is NVIDIA too close to the sun? Why Eric Fry, he's a macro guy, is concerned. Well, I'm glad he's concerned. I'm concerned too. If you're not concerned, you don't understand the deal, especially at these valuations. So I'm going to get into that. And then I'm going to talk about this article. It's called Momentum Trading and Greater Fool's Theory. Over the past few weeks, we've seen a dramatic increase in speculative stocks, the meme stocks, GameStop, AMD, those stocks. He said but in addition to that, there's a whole bunch of other stocks that are showing pretty big trading. Now, he said momentum trading is a well-respected strategy. It's known as trend following. However, he called it Newton's first law of mechanics. When the market is in motion, it's going to continue in that direction unless acted on an outside force. Now, here he said, but it's not just the meme stocks. He talks about NVIDIA and this remarkable uptrend, this unprecedented streak. And so he basically is very concerned about a parabolic rise. Isn't everybody? Now we have the article that I want to get to that was in the show notes. Now, for those of you who don't know mythology, Daedalus was a great inventor. He was like the Edison, or actually the Nikola Tesla. Edison actually stole a bunch of ideas, but the Tesla of the antiquity, right? And they had the Minotaur, the man with the head of a bull. It was a monster. And so he created a labyrinth to put him in there. Well, the King Minos, also stuck Daedalus and his son Icarus in the labyrinth because he would know how to get out. He didn't want anybody to know, for the monster to get out or anybody to get out. So Daedalus made his son a pair of wings to fly, right? And the moral of the advice he gave his son is, when you fly, it was on an island. Once you fly off, don't go too close to the water because your feathers, he made it out of feathers, eagle feathers. If your feathers get too wet, they'll get damp and you'll crash into the water. So in other words, you take off and it just crashes like a stock. You buy the stock and it just goes down. Or conversely, don't fly too close to the sun. Don't go too high, because the wax that he used will melt, and so you'll go up really high, and then you'll crash land into the water. Well, Icarus, being a disobedient son, flew too high to the sun, and the wings melted, and he crashed and burned. Okay, now, so the problem is, and it's a perfect analogy for what we're doing today, but the moral is you don't want to be too ambitious or too adamant about something, and sometimes you got to calm down and back off when necessary. But how do you participate when the market is at these levels and NVIDIA is at these levels? So very quickly, this article, NVIDIA too close to the sun. Talk about NVIDIA. It's the third most held stock in the universe of ETFs, only behind Microsoft and Apple. It's in all of your ETFs, the S&P ETFs and mutual funds, semiconductors, growth funds, AI funds, robotic funds, free cash flow funds, even blue chip growth funds, and covered call funds. So it's in over 504 ETFs. It's even in more mutual funds, but basically it's owned by over 20% of all the funds out there. Okay. So he said that's great because it's helped those funds and participated in gains. But the flip side is if NVIDIA falls, all these funds and the whole market could fall victim. Now, NVIDIA is 87 times earnings. That's a lofty valuation, and it might struggle if it doesn't keep up those gains. Okay, and then he said stocks like NVIDIA make their own rules, at least for a while. Keep in mind, markets are cyclical. That's absolutely true. And right now, except for the last day or two, the market's been cycling up. So you kind of want to be in as long as you know how to get out. Okay. Now, It says, what has Eric increasingly anxious about NVIDIA's resemblance to another high-tech darling from yesteryear? I bet Don hasn't even read this article. I bet he can guess this stock because I've mentioned this stock. It's the darling stock of the 90s that everybody owned. It's Cisco Systems. Okay? So it talked about Cisco Systems, and when the dot-com bubble crashed, Cisco was down nearly 90% from its top. Okay? So, and here's what he said. I love this. There's no such thing as a good idea or a bad idea in the investment world. It's a good idea at a price, and it's a bad idea at a price. Well, he just contradicted his whole article. Absolutely. So as long as price is truth and it's acting right, you want to be in. But as soon as it's not, that's how you want to be out. Then he talks about the ripple effect, the potential contagion if NVIDIA stumbles. It's just not the hundreds of ETFs that hold NVIDIA. It's going to have a domino effect in the broader tech industry, Meta, Alphabet, Microsoft, all that stuff. In any event, he's talking about how far NVIDIA's tentacles extends into the broader market. Folks, we've been talking about this for a couple months now. We've been talking about how narrower and narrower market breadth has gotten so that more stocks are actually struggling than actually are going up. And there's only a small subsector of stocks that are carrying the markets higher. And in fact, NVIDIA, with its huge market cap and a few others, are actually making the market show positive results when a great majority of a lot of stocks are actually down or even negative on the year. Okay, so I'm going to go directly to the mailbag, and then I'm going to throw this over to Don because this is the perfect setup. How do you participate in the market while it's acting right, but have a ripcord in case this thing rolls over and goes down? Remember, it's an escalator up and an elevator down. During the COVID bear, the market lost 35% in 3 weeks. During 2022 bear, it was a little bit more, I don't want to say, controlled. It was a little slower, but it still hurt. But it was down 28.5%. So how do you avoid, and that's two years apart. So even if you have big years between those, 21 or 20, how do you protect yourself against those down years, negating the good years? All right. So in any event, on 5/29, CC sent me this. Is NVIDIA too close to the sun? Why Eric Fry is concerned. He just sent me the headline and he sent me the article, basically letting me know I'm scared. What do you guys, what do you think about this? Because I know we own NVIDIA. So I said, that's why we have a sell discipline to control Icarus, both from flying too close to the sun and then crashing. In other words, we buy something and it goes way up. How are we able to participate but hold most of the gains? You have to give up a little bit because you can't time the top. But how do you do that? By flying too close to the sun then crashing, or simply going too low and sinking? In other words, we buy a stock and then it just goes down. How do we avoid getting double-digit losses? Because compounding works both ways. I said the markets were down. This is a couple days ago. The markets were down today, and NVIDIA was up 0.8%. That is strength from a technical standpoint. From a fundamental standpoint, while their PE is fairly lofty, you must have their chips to drive AI, and that market is just beginning. It's in its infancy. So NVIDIA could easily grow into their numbers. In other words, if you're making 100% a year, and your PE is 87, next year it's going to be half of that or mid 40s. The following year it's going to be 20s, okay? And their revenues and earnings are actually accelerating. I said, again, though, this is why we have a sell discipline, so we can feel comfortable holding, meaning holding at these valuations, but to be comfortable holding anytime. You should always have a sell discipline. We did get defensive today, as you may have noticed. Thanks, Dan. That's when the market was getting choppy. We also did some defensive selling today that I'm sure Don will get into. So with that, Don, how do you navigate these markets? You do have lots of leading stocks that are extended technically. How do you stay in so you can do that, or how do you protect profits, and what's the plan? I guess that's it. What's the plan, Don?
So let's talk about NVIDIA first, because you can't talk about, say something has a high valuation or PE ratio without talking about its growth rate. NVIDIA has a PE of 61, and fiscal year 2025, which actually started in February of 2024 and ends in January of 2025, is a 96% growth rate. So if you take the PE ratio 61 divided by the growth rate 96, you get a PEG ratio, price earnings to growth, of less than 1. Nothing that's less than 1 is quote unquote expensive. Go back historically in the heydays of NVIDIA when they were earning $2.50 in 2021. They earned $2.50 a share, and the price was at $3.46. 2025, they're earning 10 times that, 10 times $3.46. The stock's only at $10.80. It could triple and still be, relative to its price to earnings back in 2021, still be 67% less expensive. So you can't talk about PE ratios without including the growth rate in there. And even in 2026, fiscal 2026, they're still going to grow 33%. These are projections, granted, but I mean, the stock just gapped up and then gapped up again. Yes, it's given some back the last 2 days, but their earnings were just fantastic. And they're in this AI data center software build out. They quite simply, they need their chips in order to process AI. AI processing is very intensive in required computing power, and they haven't even started selling their new chip, Blackwell. Sales later this year are going to be included in that. So, take anybody saying something is expensive, you got to take it to the next level. At a minimum, you got to look at the PE and put it in context against the growth ratio. Let's look at something like Procter and Gamble. Procter and Gamble has a 24 PE and a 7% growth rate. So it's 8 times as expensive as NVIDIA on a PEG ratio basis. And all of these staple stocks are very similar. Their PE ratio is well above their growth ratio. Anyway, that's enough on that topic. Let's get back to the market. The S&P 100 2 days ago, Wednesday, closed just below the 21-day moving average. Today, breaking further below the 21-day moving average, coming into the 50-day. From the beginning of the week when we came in, we've cut our exposure down from about a 1.4 to a 0.9. So basically, we've cut a third of our exposure, and it's a combination of new buys going negative and hitting our tight stops, taking profits on later buys of recent of leaders, especially in the AI data center area, and cutting some later buys that got back to break even, and trimming some gains on some of them. And then there's others that looked great, like CrowdStrike, but for whatever reason, I know there were some competing companies, some software companies that had really bad earnings reports. This is the premier cybersecurity company, but I mean, it's dropped from 350 to 310 in 2 days. So we got stopped on some yesterday with the break of the 21 and stopped on the rest today with a break of the 50-day moving average. And it's not optimal. Obviously, we had high hopes for this. It was, doing everything that we wanted it to do, forming a very nice base, breaking above resistances. But when price turns against you, you can't question it. You just can't be a deer in the headlights. So we've gotten our stops hit on quite a few things, as I said. Cut a third of our exposure over the past week. And if the market continues to weaken, the next level that we'll be watching, and it happened little by little, Dan. It's never a one-day thing. I have been talking for a while about this consolidation that we were in after this failed breakout. But then we had what was a failed breakdown. We got back into this range on last Friday and on Monday and stayed inside of it, but then broke below it. Or sorry, this was Tuesday because of the holiday. But then broke below it on Wednesday, broke again on Thursday, and now Friday we're making lower lows. And every one of these levels has signified us getting less long. Breaking the 21-day moving average, our next target is the 50-day moving average. So we have ranges of exposure that we'll have while the indexes are within these guidelines. But this is actually one of the better acting indexes. If you go to the Dow Jones Industrial Average, it broke below the 50-day 3 days ago and has continued lower. Small caps and mid caps broke, regained, but now are breaking back below those levels today. That's the small cap index, Russell 2000 index, still holding above the 50-day moving average, but breaking back below the 21. So the NASDAQ 100 was holding up the best coming into today, broke the 21-day moving average today as well. So we mentioned last when we got this failed breakout that 4 times in the past year a very similar action, which is we're trending higher and then we have a big negative reversal day. And I'm going to point out the last 4 days. The first one was back in July. We went sideways for 3 days, then ended up breaking down, and this was the first leg down in the correction we had last July through October. Then we started a strong round in November, ostensibly on some of the Fed action. And twice during that period on the way up, we had very similar negative reversals off the top. There was one, here was another. In both cases, we continued higher. But then we had a negative reversal in the beginning of April. Again, went sideways for 5 days, and then we started breaking lower, broke the 50-day moving average. This ended up being about a 5-6% correction. It held at the 100-day or 20-week moving average. And then we had rallied off of there, made higher highs, had this very similar candle last Wednesday, and went sideways for 2 days and then started breaking down. So this is looking like it's going to go lower based on the action here and then here. Is it going to result in 3 waves down? We don't know. If it's like this one from April, which was just a simple correction of 5 to 6%, we don't know. But we do know that 20% losses started out as 15% losses, which started out as 10% losses. And you see where I'm going with this. We want to be mostly out once we hit that 5% level. That's normally we'll break below the 50-day moving average then, and then we'll be very lightly invested until the market decides what it wants to do. That's exactly what we did in this period here. Then we did some attempted rallies, failed, had an O'Neill follow-through day without the volume, but we had leadership participating, so we rode that wave for about 3 weeks. But that wave has been weakening. We never know how long it's going to go. It went 5 months from November till the end of March last time. This one has been a disappointing 3 weeks before starting to roll over, but we'll at least lock in some gains since we started to re-engage here, because we know that all of our stops get hit, the balance will be higher than it was at the bottom of this level when we started getting back into the market. So the bottom line is we'll take it level by level, stop by stop. Some things our stops are getting hit, some things they're quite away from getting hit. But we won't just stay like a deer in the headlights. This isn't good action for leaders, particularly over the last 3 days. And it was triggered by some earnings reports by some big software companies. And then Dell, which was a hardware company that was supposed to be at the forefront of AI, really had an underwhelming earnings report Thursday after the close. And that's hitting a bunch of those AI data center names today, which we've trimmed significantly this morning. And if our stops continue to get hit, we'll continue to take them out and reduce our exposure. But we'll be doing what the market's telling us to do, not based on any opinions that we have.
Or our forecast. And now there is reason to be concerned and nervous because those areas, the data centers and the AI chips, that Don's talking about, those have been the very narrow sectors that have been holding up the market. The broader market has been struggling a little bit, especially some sectors. So that's why it's key that, number one, these hold key levels, because if they don't, if those two sectors continue to start breaking down, boy, Katie barred the door. You really could see a full-blown correction or even a bear market. It could turn into something much worse. What we'd like to see, if you're bullish, is we'd like to see these names firm up and hold, but then also breadth start to expand and have more stocks in other sectors and better participation. All right, Don, what does Hunter got? I mean, Hunter.
Oh, jeez. Dan, while we're sitting here, I'm barefoot right now, but I bet Connor has his on sneakers on. Am I right, Connor? Is that what you're wearing today?
That's right. 3 pairs.
So he's going to go 3 pairs. You're wearing 3 pairs at the same time?
Wow.
No, I have 3 pairs. I'm a huge fan of the brand.
Apparently.
All right. So he's going to go through 4 footwear names, a sector that has been holding up very well. So take it away.
Yeah, to just talk what Dan was mentioning earlier, and this kind of dives into my segment, is that I mentioned those charts last week on the show, is how the NASDAQ Composite and the S&P 500 were making higher highs, while the percent of stocks above the 20, 50, and 200-day moving average were making lower highs. So there were some signs that tech was being held up by a select few stocks, and you never know when those negative divergences will play out. But despite some of the weakness in tech, there's been groups that have been holding up well, and the apparel retail sector has been one of the strongest. So if you pull up the chart of Deckers, Don, just last week, Deckers had a monster earnings gap, and it gapped up over 10% on huge volume, and it's made higher highs ever since, and it's trending up. And even on a day like today, Deckers is down 40 basis points, while the S&P is down about 75 basis points. So clear relative strength in this stock and group right now. And if you go to ON, this is another name that's been super strong, right? It broke out of this multi-month weekly base on an earnings catalyst, had 400% above average volume, and it's continued to move higher. And even from that earnings gap day, it's up another 16% from that day. So, and that's really a good indication of whether or not a group of stocks or sectors is working, right? How are the earnings reactions for these stocks? Because look at these software companies. MDB is getting smoked. SentinelOne. So based on how investors are reacting to the earnings release, can tell you are they buying these numbers or not? And Don's showing the chart right there. I mean, there's no love for that sector right now, and it's totally night and day versus what these apparel footwear stocks are doing. If you pull up Crocs as well, Don, and this is a third name in the group. This had earnings as well. This has had another earnings gap, and it's continued higher. It broke out of that cup and handle base so it had that initial earnings, and then it broke out on the 24th, and that was simultaneously the day that Deckers reported earnings. So there was a lot of group strength overall. And then Skechers as well. That's another name that continues to trickle higher. It's an older stock. It's not the NVIDIA of the world, but look at the price action of this stock. It's gone from the lows of 45 all the way to 71 now, and it's showing great strength. So I feel like I repeat this a lot on the show, but your best odds are when you can see multiple stocks that confirm your thesis on strength in a sector, because it's very tough to just find one good-looking chart in an industry group that has no strength. And William O'Neill's done work on this, and I forget the exact percentage, but a large portion of the move that a stock makes is due to its sector, right? So, and then you find your leader in the sector, and these are 4 names that have acted extremely well. And today's, I think, very notable. I mean, all these names are holding up. They're down minimal or they're slightly green on a day where a lot of money's flowing out of tech. So maybe more money flows into these stocks, but the price action of them has been really good lately.
All right, Connor, good stuff. Yeah, every weekend we go through sectors. I think it's 45% combined of a stock's performance is based on the combination of its sector and its industry group, and we go through these and rank them every weekend. And here's the apparel, shoes, and related manufacturing industry group, and you can see the relative strength on there and how it's just been moving higher relative to the market, compared to, as you mentioned, software stocks and semiconductor stocks, which had led for a while, but have gotten hit over the last couple of days. So we want to make sure we're fishing in the right ponds. So good stuff there, Connor. Dan, that wraps it up from the tech side, coming into the 50-day moving average here on the S&P 500, and important that level holds. That level right now is at 51.79. We're trading at 51.95 right now, so not a whole lot of room left between here and the 50-day moving average on the S&P 500.
So we may be getting more defensive, and I want to give the new listeners. I know some of the older listeners have heard this before, so at the chance of sounding a little redundant, I want Don was talking about the sectors and subgroups that they look for to make sure he's fishing in the right pond, folks. IBD methodology tells you that you want to kind of stay in the top 50 subgroups because that's where the institutional money, the hedge funds, the pension funds, that they've got to own those for them to be in the top 50 subgroups. Mom and pop retail investors don't have enough money and don't have enough strength to push those sectors, subgroups in the top 50. But it's not just about the top 50 itself. It's the direction and the jockeying. So of those 197 subgroups, I'd rather have something that's 70 in the 70 group. It was 150 and then 120 a few weeks ago, and now it's 70 and it's moving into the top 50. Then something that's 35 subgroup, but was 5 3 weeks ago and was 15 a week ago, and now it's 35. Obviously, money's moving out. See, these big, huge funds, they can't just sell everything all at once. It takes them a couple weeks to move out of positions. And so that's why it's real important. But not only that, once you see that a subgroup is moving up in the ranks, okay, then you can go into that subgroup and then you can look at the individual stocks within that subgroup. Obviously, the top leading or the top 2 leading stocks in that subgroup probably is already extended because that's what's making that subgroup move, and you got a couple leaders, but you'll find a couple other stocks in that subgroup that just haven't caught on yet, or they're not starting to lead, and you can find them poised to break out. So in one way you can use that is you can find stocks in subgroups earlier, and likewise, or on the flip side, you can also figure out which subgroups you may want to avoid. Because if you're finding a stock that is looking pretty good, but then you look at the subgroup and that subgroup is at 70 and was at 20 and then at 50 and now it's at 70 and money's moving out, there's always exceptions, and you may find a one stock in a subgroup bucking the trend, but mostly the stocks within that subgroup are pretty correlated together and move together. And if you do decide to go ahead and buy it, you might want to keep your stops a little tighter. So it can help. So I just wanted to bring that up. I know I've mentioned that every couple, 3-4 months, but I wanted to bring that up because we get a lot of new listeners all the time. And speaking of listening, we want to thank you for listening. And up in the right-hand corner of the website at revereasset.com, you can just go and there's a subscribe button. You can tell your friend, tell your neighbor, just go to revereasset.com and they can put their name and email address in there. And our daily market insight video, Don does a video every night the market is open. Pretty soon, Connor and Ted are going to start doing those. Every night the market's open, we do a short market video telling you exactly what we're doing and the short-term, mid-term, long-term strength of each of the major indices. Okay? So we're the most transparent advisor that I'm aware of. And next to that is a contact us button if you want to reach out to us and you have a question or a stock you want us to discuss on the show, or you simply want a complimentary portfolio review. And you can always, always, always call us old school at 855 Real Wealth. Folks, we will talk to you next week on your money, because it's not their money, it's your money.
It's not how much you make in the market, it's how much of that you can keep.